Hello, my name is Robert Farrington, and this episode of the 15-Minute Money Bootcamp from the College Investor is all about how to qualify for a home loan. So I am excited to talk to you today about all the factors the major factors that are going to help you qualify for a mortgage or home loan. This question came from a reader last week who was concerned about what it would take to qualify for a home loan and could I qualify for a home loan with student loan debt. So I'm going to take a few minutes here and I'm going to walk through the factors that you need to know to qualify for a home loan and how you can influence those factors. So let's jump right into it, guys. The three major factors to qualify for a mortgage are your debt to income ratio, your credit score, / your history, they both go hand in hand though, and your down payment and the value of the home. There are many more. These are just the major ones. And as you're going through the process of qualifying for a home loan, which is also sometimes called the underwriting process, you might encounter other different issues, especially if you run your own business or if you have a unique situation. But these are the major factors. Your debt to income ratio is a pretty simple calculation. It's the total monthly debt payments you have divided by your total monthly income, right? So banks and lenders are looking for a debt to income ratio of between 28 to 44%. Somewhere in about the 33-35% range is average, but this is 28 to 44%. It's probably about 80 to 90% of lenders are looking for the maximum debt to income ratio in that range. Now, how do they look at your total monthly debt payments? Well, they look at your mortgage that you're trying to qualify for. They look at any other loans you might have. So if you have a car loan or student loans, those monthly payments get factored into this equation. And they also look at what your minimum payment is on any credit cards that you might have. So here's a tricky one, right? If you pay off your credit cards in full every single month, that's great. But unless that balance is zero, your credit card company still reports a minimum payment due to the credit bureaus. So an easy way to, boost your debt to income ratio or improve it right before you qualify for a home loan is to simply not use your credit cards for a while and pay cash and keep those balances at zero. And that'll show that you have zero monthly minimum payment, and it will help your debt to income ratio. But let's break down some examples, guys, so you can really get a feel for it, because the debt to income ratio is one of the biggest qualifying factors to get a home loan. So in this example, this person has a total debt payments of $500 per month. Could be a credit card, a car loan maybe, and they have an income of $2,000 per month. So their debt to income ratio is 25% right now. If they wanted to get a home loan, let's just go to another example here. Let's just say they go to $1,000 a month in debt payments. So let's just say they have a credit card, student loan, car payment, and then let's just say $500 of that is their home loan, the one that they want to take out. And they're making $2,000 per month. Well, their debt to income ratio now is 50%, 1,000 over 2,000, and that's pushing it. That might not get you qualified right there. So really keep that in mind as you're going through this process. They're looking at your debt to income ratio right now, but lenders are also going to be looking at your debt to income ratio after you take on this mortgage, which is probably going to be the biggest debt you owe. So how do student loans factor into this? Well, no matter what repayment plan you're currently on, lenders only consider your standard 10-year payment for your debt to income ratio. So let's say that you're currently on income-based repayment, IBR, and you have a great low monthly payment at, $45 per month. But if your standard repayment amount that you originally had before you went on IBR was $150, well, your lender is only going to consider the $150 per month amount. So this kind of puts you at a disadvantage when it comes to purchasing a home, because that makes sense. You can't afford your student loans without being on an income-based repayment plan. So it's really scary for a lender to possibly qualify you for a home loan. So it makes sense, but you could still work with that as long as you realize how they're calculating this equation out. You could still be on an income-based plan and possibly qualify for a mortgage. It's just very rare. So here's a fun quote as we keep going through this. In past times, your social security number was the most influential number known to man. However, the 3-digit number that is giving Social Security its run for its money is your credit score. Okay? Your credit score is going to be the next biggest factor. And I put in the beginning slide your credit score and your history because they really go hand in hand. Your credit score is based on your history. Credit score is a snapshot, but your history plays a part in this as well. So your credit score needs to be good. You need to have good credit to get a loan and a mortgage. That makes sense. What numbers are important? Well, if you want to get the best rate possible, 740 is what you need. You need to have at least a 740. A conventional lender typically requires a score of at least 700 if you just, want to get a mortgage. FHA loans require at least a 580. A 580 is a pretty low credit score, but these are people starting out too. These are great loans if you're starting out, you're rebuilding your credit, you've made some good strides in the last year or two, but maybe your long way back past is still haunting you. Well, that's the cool thing. FHA loans, take that into consideration. And some lenders will go as low as 620, but realize if you have a low credit score, you're going to pay a lot more for that house. Your credit history is just as important as your score. So as you can see there, your FICO score, your credit score, is based on your payment history, your length of credit history, your amounts owed, your mix. So there, a lot of your factors in your history factor into your score. So it's just as important. Beyond that, VA loans and USDA loans don't even have a credit score minimum, but they do have guidelines for your credit history. So, they might not say you have to have a certain score like a 580, but you have to have done certain things or not done certain things in the last period of time. So know your score. I cannot emphasize this enough. There's a lot of free tools out there. Credit Karma is my favorite. It allows you to check your credit. It doesn't give you your exact credit score, but it gives you a Vanguard score, which is a very similar score. I suggest that you use a credit card instead of a debit card for all purchases, which is in one of our other videos that you should check out on why debit cards are bad and you should use credit cards for everything. And I think you should shoot for a score of 800 or higher. It's possible. I have a score of 800. My wife has a score of 800. If you use credit responsibly for a long period of time, you will naturally get a good credit score. And I just want to share with you how 1% makes a huge difference. So if you have a bad credit score versus a good credit score, it could be a 1% difference in your mortgage interest rate. So if you get a 30-year fixed rate mortgage for $200,000, a 4% loan is a monthly payment of $954 per month. But if you have bad credit and they make you pay more for your mortgage, you might have to qualify for a 5% interest rate. And that loan payment is $118 more per month at $1,073. That's $1,400 a year. And then you go for like a 30-year loan, right? That adds up to thousands and thousands of dollars that you're leaving on the table because you have a poor credit score. Finally, the last factor is your down payment. So if you want to get the best interest rate, you need to have a 20% down payment. VA loans and FHA loans, they go as low as a 3% down payment. But if you don't have one of those loans and you're looking for a mortgage, if you have less than 20% down, you're going to have to pay private mortgage insurance, PMI, and you're probably going to have a higher interest rate. So save up as well. It's not just about having great credit, but you want to put more down for that house. Finally, beyond the down payment, the house has to appraise for the price that you're offering. So, keep that in mind that if it comes in well under your offering price, you might not be able to qualify for that mortgage, or you might qualify for less of a mortgage, and you're going to have to renegotiate with the seller. So your home has to appraise. It's another key factor. You must also have an emergency fund or cash reserves after escrow closes of at least 6 months. So, we talk about saving. You're saving this 20% for a down payment. Well, if you don't save another at least 6 months of payments, and this is principal, interest, so your mortgage payment, insurance, property taxes, if you don't have 6 months in the bank after you buy a house, the loan might still not go through because the lender is going to be scared. Like, are you blowing everything you have for this down payment? And then you might not be able to pay your bills next month. So they want to see that you have at least 6 months of savings after you close on the house. And you also need to realize that moving is expensive. And furnishing a new home is expensive. No matter what, I have never moved in my life without spending about $1,000. Like there's always something. There's moving expenses. Something always breaks. You get into your new house and you need to do a repair, or you need to buy something because you didn't have it before. So moving is expensive. So realize that you're going to spend at least $1,000 to $2,000 in new home expenses like day one just to get your house. So hopefully that really made a lot of sense for you. We have this time open for some question and answers. This was from a Facebook Live video, so there's no Q&A right now. But you can learn more about what we're doing to help people get out of student loan debt and start building wealth for their future at thecollegeinvestor.com/15 minutes. Check out our Facebook Live videos. Engage with us on the site. You can leave a comment in our forums, or you can also find us in the comment section on facebook.com/thecollegeinvestor. All right, guys, thank you very much. I appreciate you spending a few minutes with me learning about what it takes to qualify for a home loan. This is Robert Farrington signing off. Until next time.